You need to pay close attention to what I am about to tell you, because something unusual is happening beneath the surface of the financial system, and most people are not seeing it yet. While headlines are focused on Bitcoin falling from above $120,000 to the $70,000 range, large pools of capital are moving quietly, methodically, and with a patience that retail markets rarely understand. When price collapses, but long-term holders are not selling, when exchange reserves continue to decline instead of rising, when volatility increases, but structural demand does not disappear, these are not normal signals. These are fracture lines in the narrative the public is being shown. Over the last 6 months, you have watched one of the most dramatic cycles in recent crypto history. Prices surged to record territory in October, fueled by liquidity flows, leverage positioning, and momentum chasing. Trading volume exceeded trillions of dollars in a matter of weeks, but then the tone changed. Liquidity began to thin, volatility expanded, risk appetite shifted globally as bond yields fluctuated and capital rotated across markets. What you are seeing now is not just a price correction, it is a transition phase, the kind that has historically separated speculative rallies from structural accumulation periods. If you step back and look at financial history, this pattern is not new. During the early 1970s, before gold entered its most explosive decade, the metal experienced violent corrections that convinced many investors the bull market was over. In the late 1990s, before the dot-com collapse, capital moved silently into certain technology sectors, while the broader public remained unaware. Markets rarely move in straight lines, and the most decisive shifts often occur when confidence appears to be breaking. Now, look carefully at the signals that most people dismiss. Mining difficulty has dropped sharply, forcing weaker operators out of the network. That sounds negative at first, but historically, minor capitulation has often marked transitional phases in the cycle, not final collapses. When inefficient producers leave, the remaining network stabilizes and forced selling pressure decreases. Block times normalize, supply shocks fade, and the market quietly resets itself. At the same time, institutional discussions around digital assets have not stopped. Conferences continue to attract capital allocators, policymakers, and infrastructure developers. Regulatory frameworks are being debated and refined. Stablecoin legislation, central bank commentary, and discussions around monetary architecture are taking place in parallel. These are not the behaviors of a system that is fading away. These are the behaviors of a system being integrated slowly and unevenly into the broader financial order. And here is where the contradiction becomes impossible to ignore. Public sentiment has weakened. Retail participation has cooled. Media narratives are cautious, sometimes openly pessimistic. Yet beneath that surface, large holders are not behaving as if they expect a prolonged collapse. Long-term wallet data, OTC activity, and declining liquid supply suggest patience rather than panic. In macro terms, this resembles accumulation phases seen in commodities, currencies, and even sovereign bond markets during transitional cycles. You are looking at a market caught between two realities. One reality is visible: volatility, uncertainty, regulatory debates, and sharp corrections that shake confidence. The other reality is quieter: structural adoption, capital positioning, and long-term strategic interest that does not depend on short-term price movements. These two forces rarely move in harmony, and when they diverge, confusion dominates the public narrative. So the real question is not whether Bitcoin has fallen from its peak. Markets always rise and fall. The real question is whether the underlying demand structure is weakening or silently strengthening while attention is elsewhere. History shows that the most significant reallocations of capital often occur during periods when the majority is distracted, discouraged, or convinced that the opportunity has already passed. Right now, you are standing in one of those moments where the surface story and the underlying reality may not be the same. And when that happens in global markets, the consequences are rarely small, rarely predictable, and never obvious in real time. You need to understand what volatility really means, because what you are seeing on the charts is not chaos without reason. It is the visible surface of a deeper liquidity cycle that has repeated itself in every major market, from equities in 1929 to oil in 2008, and even to sovereign currencies during monetary crises. When Bitcoin surged above $120,000, the atmosphere was electric, and capital was moving fast, sometimes irrationally fast. But markets do not move upward forever. They pause, they correct, and sometimes they unwind violently when leverage begins to collapse. Look closely at what happened after that peak. Trading volume reached extraordinary levels, over $2 trillion in a single month. That kind of volume is rarely sustainable. It often signals a transition point where early participants distribute positions and late participants enter with maximum enthusiasm. This is not unique to crypto. It is the same psychological cycle seen in the housing bubble before 2007 and in technology stocks before the dot-com crash. Liquidity expands, prices accelerate, and then the system begins to strain under its own weight. What most people do not realize is how closely Bitcoin now moves with global macro forces. 10 years ago, it behaved more like an isolated speculative asset. Today, it reacts to bond yields, to Federal Reserve expectations, to dollar strength, and to global risk sentiment. When interest rate expectations rise or financial conditions tighten, capital naturally retreats from high volatility assets first. This is not fear alone, it is mechanical. Funds rebalance, portfolios de-risk, and liquidity moves toward perceived stability. You have seen this pattern in recent months, as global markets adjusted to shifting expectations around inflation and monetary policy. Risk assets across the board experienced turbulence. Equity indices hesitated, commodities fluctuated, and cryptocurrencies followed the same rhythm. This is the sign of integration into the broader financial system, not isolation from it. Bitcoin is no longer just a fringe experiment. It is part of the global liquidity cycle, and that means it inherits both the inflows and the outflows of that system. But there is another force at work, one that most people underestimate: psychology. Markets are driven as much by perception as by fundamentals. When prices rise quickly, investors feel urgency and fear of missing out. When prices fall sharply, that urgency transforms into hesitation and doubt. The same crowd that was certain of endless gains becomes convinced of endless decline. Yet history shows that both extremes are usually wrong. Markets tend to reverse not when everyone is optimistic and not when everyone is pessimistic, but when conviction becomes one-sided. Think about the parallels with gold in the late 1970s. After dramatic rallies, gold experienced violent corrections that convinced many investors the bull market was finished. Yet those corrections occurred within a larger macro shift, driven by inflation, currency instability, and geopolitical uncertainty. The lesson from those periods is not about the specific asset. It is about the nature of cycles. Liquidity expands and contracts, confidence rises and falls, and the narrative changes faster than the underlying structural forces. Now, look again at the present moment. Bitcoin has fallen roughly 40% from its recent peak, and that number alone is enough to dominate headlines. But volatility of this magnitude is not unusual in emerging or high beta assets. What matters more is how the market behaves after the shock. Does liquidity disappear entirely, or does it stabilize? Do long-term participants exit, or do they remain? Does infrastructure continue to develop, or does it stall? What you are witnessing right now is a market searching for equilibrium after an extended period of excess. The leverage that fueled the rally is being unwound. Speculative positions are being cleared. Short-term traders are leaving, and longer-term participants are assessing the landscape. This process is uncomfortable, sometimes frightening, but it is also necessary. Every mature market has gone through similar phases, from railroads in the 19th century to internet companies at the turn of the millennium. So, when you look at the volatility, do not see it as random noise. See it as the system recalibrating itself under the pressure of global capital flows, monetary policy expectations, and human psychology. The swings feel dramatic because they are happening in real time. But in the broader arc of financial history, they are part of a familiar pattern. And the most important movements in markets are often not the sharp spikes or sudden crashes, but the quiet shifts in liquidity and sentiment that occur afterward, when attention begins to fade and the next phase of the cycle starts to form. You need to watch the mining sector very carefully right now, because what is happening there is one of the clearest stress signals in the entire system, and most people are not paying attention to it. When mining difficulty drops sharply, when block times stretch, and when smaller operators begin to shut down machines, it is not just a technical adjustment inside a network. It is a reflection of real economic pressure, the kind that reveals where the system is weakest and where it is beginning to adapt. In early February, mining difficulty fell by more than 10%, one of the largest declines since the shock of the China mining ban in 2021. That kind of adjustment does not happen without cause. Energy costs, hardware financing, and operational expenses have been squeezing margins for months, and when prices fall at the same time, weaker miners simply cannot continue. They are forced to sell reserves, liquidate equipment, or shut down entirely. This process is brutal, but it is also part of how every commodity-based system stabilizes itself. If you look at history, you will see the same mechanism in oil markets. When crude prices collapse, high-cost producers shut down first. Production falls, supply tightens, and eventually the market finds a new equilibrium. The same thing has happened in metals, in agriculture, and even in shipping cycles. Bitcoin mining follows a similar economic law because at its core, it is an energy-driven production system competing on efficiency. What many people misunderstand is that miner capitulation is not always a bearish signal. In many cycles, it has appeared near transitional phases, moments when excess leverage and inefficient operations are flushed out of the system. When weaker participants exit, selling pressure gradually decreases. The network becomes more efficient, not weaker. Hash rate stabilizes, block intervals normalize, and the constant forced selling that weighs on the market begins to fade. But there is another layer to this that you need to understand. Mining is one of the few parts of the Bitcoin ecosystem that connects directly to the physical economy. Miners pay for electricity, infrastructure, cooling systems, and logistics. They borrow capital, hedge costs, and manage cash flow just like any industrial operation. When stress appears in this sector, it is often linked to broader macroeconomic conditions. Interest rates, credit availability, and energy prices all play a role. Over the past year, the global cost of capital has remained elevated compared to the ultra-low rate environment that fueled earlier expansions. Financing equipment is more expensive. Refinancing debt is more difficult. Even large mining firms are operating in a tighter financial environment. This is not unique to crypto. It mirrors what manufacturing companies and infrastructure projects have experienced worldwide as monetary policy tightened and liquidity became more selective. And yet, despite this pressure, the network continues to function. Blocks continue to be produced. Transactions continue to clear. Difficulty adjusts just as it was designed to do. This is an important point because resilience under stress is one of the strongest indicators of structural durability in any system. Markets can fluctuate wildly, but the underlying mechanism continues to operate, adapting in real time. At the same moment, you are seeing discussions about the next difficulty adjustments potentially rising again, suggesting that stabilization may already be beginning. That is how these cycles often unfold. First comes stress, then capitulation, then stabilization, and only later does recovery become visible to the broader public. By the time headlines declare that the worst is over, the most important adjustments have usually already taken place. So when you hear about miners shutting down or difficulty falling, do not interpret it as a simple sign of collapse. See it as part of a larger economic cycle playing out in real time. Every financial system, Every commodity market, every industrial sector goes through phases where inefficiencies are removed and the structure becomes leaner. It is uncomfortable to watch, especially when prices are volatile and narratives are uncertain, but these moments often shape the foundation of whatever comes next. Right now, you are witnessing one of those structural resets happening quietly in the background, while most attention remains fixed on price charts. And in markets, the events that receive the least attention are often the ones that matter most in the long run. You need to pay very close attention now, because the final piece of this puzzle is not price, not mining, and not even volatility. It is policy, regulation, and the slow but powerful machinery of governments and financial institutions adjusting to a world where digital assets are no longer a fringe experiment. These forces move slowly, sometimes so slowly that most people stop watching, but when they finally shift, the impact can be enormous. Over the past year, you have seen political language around digital assets change. Discussions that once sounded dismissive have turned into debates about frameworks, oversight, and integration. Stablecoin regulation, custody rules, reporting standards, and institutional access are no longer theoretical topics. They are being drafted, negotiated, and implemented step by step. This process may look bureaucratic, but in financial history, regulation has often been the signal that an asset class is transitioning from speculation to infrastructure. Think about the history of futures markets in the 1970s, or the regulation of derivatives in the 1990s. At first, these markets were volatile, loosely structured, and widely misunderstood. Over time, as rules were established and institutions entered, volatility did not disappear, but participation broadened and capital flows became deeper and more stable. The same pattern is now beginning to emerge in digital assets, though the process is uneven and often controversial. At the same time, central banks and policymakers are navigating a complex macroeconomic environment. Inflation cycles, sovereign debt levels, and shifting currency dynamics are creating pressures that did not exist a decade ago. In such an environment, governments cannot ignore alternative monetary technologies, even if they do not fully embrace them. Discussions around digital reserves, settlement systems, and cross-border payments are no longer confined to academic papers. They are appearing in policy conversations and financial conferences around the world, and here is the contradiction you must understand. On one hand, markets appear uncertain, prices fluctuate, and sentiment remains fragile. On the other hand, the infrastructure surrounding digital assets continues to expand quietly. Conferences are held, institutional panels debate custody and liquidity, and financial firms continue to build systems designed for long-term participation rather than short-term speculation. These are not the actions of an industry preparing to disappear. They are the actions of an industry preparing for a different phase. You have to remember that markets often misinterpret the timing of change. When railroads were being built in the 19th century, many early investors went bankrupt, yet the infrastructure transformed entire economies. During the early days of the internet, countless companies collapsed, but the network itself continued to grow, eventually reshaping global commerce. Structural transformations rarely look stable while they are happening. They look chaotic, contradictory, and uncertain, exactly as this moment does now. What you are witnessing is a financial system in transition, not from one price level to another, but from one era to another. The old framework of purely national monetary systems is being challenged by technologies that operate across borders and time zones. Governments are responding, sometimes cautiously, sometimes aggressively, but always with the awareness that ignoring the shift entirely is no longer an option. And this is why the present moment feels so tense. You are seeing the collision of two worlds, the fast-moving, high-volatility world of digital markets and the slow, deliberate world of policy and regulation. One moves in minutes, the other in years. When these two speeds intersect, the result is uncertainty, sharp price movements, and conflicting narratives that leave observers unsure of what comes next. So as you stand here now, watching this market move day by day, Remember that the most important changes in financial history have rarely been obvious in real time. They were recognized only later when the evidence became impossible to ignore. Right now, you are living inside one of those transitional periods where the signals are fragmented, the conclusions are unclear, and the final outcome has not yet been written. And in moments like this, the only certainty is that the system you see today will not look the same a few years from now.